Hello and welcome. Today we're discussing Illinois Toolworks, ticker ITW. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company has a market cap of $72.8 billion, enterprise value of $78.8 billion. So you see about $6 billion in net debt on this business. That's not that high because you can see it's less than 10% of the overall enterprise value. Operating in the machinery industry, they manufacture, sell industrial products, equipment worldwide, 7 segments. That's a lot of segments. Automotive, OEM, original equipment manufacturing, food equipment, test and measurement electronics, welding, polymers, construction, and specialty. So all across the gamut. So they offer plastic and medical components, fasteners, assemblies for automobiles. They provide warewashing, refrigeration, cooking, and food processing equipment, test and measurement, consumables, software. Welding equipment, arc consumables, adhesives. So this is almost a conglomerate in machinery, but it's just a general machinery company that's worth knowing. It looks like it's operating in many different industries, some cyclical, some not. So that's a good background on what this company is doing. I'm a little surprised seeing the share turnover at 88%. So this is still a pretty high share turnover, but it's actually lower than I see a lot of times for S&P 500 companies because it's below 100%. Something to think about with the company. Lower share turnover tends to be better. Now, return on invested capital, first sign of seeing this as being a high quality business is that you have 20 straight years of profits. There's not a single year of unprofitability here. It looks like your lowest years, 2002 with 8.9%, 2009 at 8%, and 2013 at 10%. Basically, the bottom of their cycles, because they're clearly cyclical, you see this up-down motion, right? So you're going, up in 2013, down to 8%, up to 17%, down to 8%, up to 19%, down to 10%. So it's cycling. So this is definitely a cyclical company. But what's nice about it is despite being a cyclical company, their cyclical troughs are profitable and you're still earning 8 to 9% returns on invested capital. So that's actually quite good. Some cyclicality is acceptable as long as you're continuing to make a profit in all years. That helps prevent major losses. It's a little bit of a margin of safety. So despite this being a high quality company, there is a little bit of cyclicality. So I'd kind of shifted to more the above average business. Averages businesses tend to be cyclical, but not high quality. This is both definitely a cyclical, high quality business. Now, return on invested capital, 19%. This is exceptional. Return on equity of 54%, also exceptional. These are very good numbers. They would definitely hit the mark of what I'm looking for in a watch list type company. I want to see very large returns on invested capital so that when the money is reinvested, I can earn a very high return on my own capital as a shareholder. However, the growth is basically non-existent. You see revenue growth of 0.7%. So let's generously say that the revenue growth is 1%. You're going from $14.1 billion in revenue to $15.9 billion in revenue. This company is clearly maxed out its market share. It's not stealing share consistently. It's not growing consistently. This is a stable business. It's a strong, high-quality business, but it's not growing. Without that growth, your high return on invested capital, your high return on equity is almost useless. It's not useless, but it's almost useless because what this number means is when you retain earnings, what return are you going to get on that earning? But the growth is telling me I'm unable to retain earnings in order to grow. I can't retain more money to grow more. Retaining earnings doesn't get me anything. So it means the incremental return on my capital is actually, if it's really high, it might be, but the ability to reinvest is incredibly low. And the ability to reinvest is a very important component for long-term compounders. You can have a high-quality business like this, but you can also be high quality without the ability to compound at high rates over time. And I think that's what we have here, which is particularly a problem for the valuation ratios we're seeing. PE ratio of 23.5, price to book of 23.5. I don't know if I've ever seen a price to earnings and price to book to be the same on a company. That's very interesting. But PE of 23.5 is telling me, hey, this is a relatively expensive business. It's not uncommon for a high quality business to trade, at a PE of like 20, where you get like a 5% earnings yield. This is about a 4.5% earnings yield. And so what sort of returns can we expect from a 4.5% earnings yield? Well, if we add the earnings yield of 4.5% to the revenue growth of 1%, you're expecting maybe a return of 5.5%, maybe. And if we're generous and we say, okay, well, the earnings yield is 4.5% and you're growing at 5%, maybe you can get up to 9.5% returns. But now we're capping our returns in that 5.5 to 9.5% range. Nowhere in that range do I see double digits, which is what I'd really like to see for a potential investment for myself. So let's go down to some of the data and see if we can decipher a little bit more. We can see that the revenue grew about 10% a year and the gross profit grew about 20%, or 10% total, 20% total. So that's about 1% return for the revenue, 2% on the gross profit. That's telling me we're getting a little bit of operating leverage, and you can see that as the gross margin grew from 39.5% to 40.8%. The next piece is we're getting a little bit more operating leverage because we went from $2.5 billion in operating profit to $3.7 billion in operating profit. So you almost grew your operating profit about 50% over the course of the decade. That matches up pretty well with a 4.9% EPS growth rate, which is pretty good. But again, some of this is probably not repeatable. You've gone from a 17.8% operating margin to 23.8% operating margin. So you've added 6 points of operating margin while only adding 1 point of gross margin. You can't continue to repeat. If you did that another 10 years, you'd be at 30% operating margin. You did another 10 years, you'd basically have your operating margin close to gross profit margin, and that's just not possible or feasible. So it's valuable, but it's mainly valuable for past shareholders. As a future shareholder, you need to be thinking about what are the margins going to do today. Can they decline? That would be devastating. But even if they increase, it's unlikely to repeat another 6% of operating margin over the next decade. That would just be very hard to do. Now, on the bottom line, our numbers actually look pretty attractive. We've gone from $3.74 to $9. So not tripling, but over doubling over the course of a decade, which actually would be better than this 4.9% EPS growth rate. I think the only reason this is maybe showing a little lower is maybe trailing numbers are a little bit worse than these numbers we're showing for 2022. Just something to think aware of, but the actual earnings growth has been quite impressive. It looks like double-digit earnings growth, so that is a respectable number to get. Likewise, you've had a dividend grow from $1.60 to $5 per share. That's about tripling your dividend over the course of a decade, which is, again, a very attractive dividend growth rate. I mean, look at some of these numbers here on a yearly basis. Your lows are in the 6 and 7%, but your highs are like 14, 15, 19, 24%. Very respectable dividend growth rates over time. You like to see that as a shareholder. Now, this $5 dividend, what's our current yield? $237 stock price, $5 dividend means your dividend yield is about 2%. I mean, there's a lot of ways we can take that to say, okay, well, what is that 2% dividend yield going to mean for our future returns? 2% dividend yield plus 1% revenue growth rate is a 3% return. Well, that's not very attractive. 2% dividend yield plus our EPS growth rate of 5% gets you to a 7% return. Also not very attractive. All this is saying this company without revenue growth is likely overvalued. Now, we can learn more as we go to the income statement. If you're learning something from this video, hit that like button. If you're enjoying my content, hit that like button. Don't forget to subscribe. You don't have to necessarily like this company. That's just tell YouTube, hey, you're enjoying my content. I would really appreciate that. Now let's look at SG&A. How do you get operating leverage? Well, one way is if you're not growing very much, manage your SG&A costs very well, and they do this phenomenally. $2.8 billion in SG&A to begin the decade to $2.6 billion at the end of the decade. Other operating expense dropped from $250 million to $126 million. So they've managed their costs extremely well. The gross profit only went up 20%, but operating profit went up 50 to 60% because they actually reduced their expenses while growing their profits. So that's how you want to manage your balance sheet and your income statement. Your income statement during a decade where you're not growing a lot is you really need to tighten expenses. You really need to manage them well, and it looks like they've done so. So kudos to the management team for how they've managed that. That has done a phenomenal job. Pretty stable net interest income. It might be a little higher in the future depending upon how much their debt burden is, but we'll take a look at that. You can see that big income tax drop in 2017 with the tax changes. The other thing that's worth highlighting here is shares outstanding. So you can see the buybacks have been pretty attractive for this company. You've gone from 449 million shares outstanding to 311 million shares outstanding. So they've retired somewhere in the range of 130, 140 million shares outstanding. It's about a third of the share buybacks. You're seeing about 3% per year boost from share buybacks, which is a very attractive way to go from, of course, 1% revenue growth to about 4% EPS. You're getting that other boost, coming from stuff like the SG&A, expense control, and different things like that, that operating leverage. So you're getting a pretty attractive earnings per share growth rate, $3.74 to $10.11. Actually, what the growth rate is higher than what this number is, showing 5%. It's definitely higher than that because you're more than doubling, and doubling in a decade would be a 7% growth rate. So we know we're doing better than that. You're probably doing double digits, 10, 12%. So the earnings per share is doing really, really well. But to me, that's part of what would worry me about this company is that a lot of this isn't repeatable. You're highly unlikely to continue growing your operating margin at such a fast rate. I don't know how repeatable some of these share buybacks are. A lot of that was front loaded. They've slowed significantly in recent years. And so I just worry about the future with the company so far from what I'm seeing. Balance sheet, $2 billion in PP&E, $2 billion in inventory, so that's $4 billion. Pretty strong returns, but again, we have good returns here. They're very good returns on invested capital, so that's not a surprise. Let's look at our debt, $6.1 billion in debt. So that matches up pretty well. Not a big concern on the debt. They have grown it, but not a ton. Cash flow. So let's take a look. So PP&E, it looks like at the beginning of the decade, they were reinvesting less than they were depreciating. So that kind of brings your asset picture down some. And now it's kind of closer, but they're still reinvesting less than they're depreciating. So you're getting a better and better asset picture over time. What that does is, this is why you see this kind of like stagnant PP&E number, but your goodwill's actually come down. Your intangible assets have come down. You're using less assets than you did a decade ago. Again, very strong balance sheet management, very strong income state management. The management is executing very well in this business. There is some stock-based compensation, which I'd like to get rid of. I mean, you're giving people stock, but the company's not growing, so I don't really like that. They do have periodic acquisitions, so you kind of need to take into account those acquisitions. You can also see how heavily the buybacks were front-loaded here for $2 billion, $4 billion, $2 billion, $2 billion, and yet you have some recent years that haven't even hit $1 billion. Cash paid for dividends is significantly higher now, so they're shifting from doing low amount of dividends, high amount of buybacks to more dividends, less buybacks. Just a change in the capital allocation. The struggle here is management has clearly executed. This is clearly a high-quality business, but there's so much that's outside of their control. They don't control the size of the market. They don't control this revenue growth to that big of a degree. It's very clearly a company that's large, it's stable, it's high quality, it's secured a good level of market share across a many diverse set of businesses. But without that growth, the future is less certain. The future is a little bit bleaker than the past. And so for that reason, it won't hit my watch list despite the 20 straight years of profitability, despite being a high-quality company. It's relatively expensive, and I don't see a clear path for me to get a double-digit return. So for that reason, I'm going to pass on Illinois Tool Works. If you enjoyed this video, if you learned something, hit that like button. Don't forget to subscribe. And if you want to see the companies that did get to my watch list, check out the playlist of the over 50 companies that are already on that list who have met all the criteria I'm looking for in a potential investment. I hope you'll check those out. And QuickFS.net is the tool I'm using to present this video. This is a great tool to study a company in about 10 minutes. The first link is in the description below. That's my affiliate link. Please use my link. Great way to support the channel. Thank you for listening. Until next time, stop paying fees, start building wealth.